this is a home ownership workshop. My name is Greg Jackson, your community realtor, and we are honored to have the senior loan consultant, Roland Macias. And as we present our presentation today, Roland will be our main speaker, but we want you to know that we are dedicated to serving the community, and we believe that home ownership is a major part of your economic freedom. Right? And again, this is my information that you can record or take a picture of so that you can contact me in the future if you need to. And this is Roland Macias information, and that will be seen and displayed again. Roland's our primary speaker for today. We have a lot of trust in Roland. Again, as I said, he helped us with the purchase of this home, and he just has so much information that we're honored that he is our guest speaker for this presentation. And this is just a little bit of information about me. I just want to share that I wish to serve as your community realtor, but I'm coming from a background of serving in the United States Marine Corps, public education, serving both in the city and federal government in education and environmental management, and then involved locally in our neighborhood councils as a treasurer and secretary. As I move into the area of real estate, I'm dedicated to serve, as I have been all of my life. I'm dedicated to community development. And as we said earlier, we really view home ownership as the greatest economic freedom for our community. So we really want to work on that. As a realtor, I'm dedicated to serving you, the buyer, in several different ways, in 8 different ways, both locating property for you, presenting offers for you, assisting you as the buyer in negotiating and accepting offers, helping you with the financial process, which is the reason for this presentation. And then as you are going through the inspection process of your home, providing references for you for those professionals that will help you with that process, the inspection process, ordering the different reports that you need as a buyer, providing help and guidance with just anything related to acquisition of the property, and then obtaining the credit report of the buyer as part of the buying process. Again, all of that brings us to our main focus for this presentation today, having Roland here to work with us and talk with us and share information with us. We know that we won't go over everything, answer all your questions in this session today. It's just an overview. So we have 3 mini workshops. First one starting at 9 for the first-time buyers. Then at 10 o'clock, a second workshop for move-up buyers. Then 11 o'clock, homeowners that want to renovate their current home. Again, you can attend all 3 of the workshops or attend just the one. Right? So you've seen the objectives for each of the workshops in the emails that we sent out to you. So we just go through those rather quickly. And then we just want to say that as we're going into the Zoom, we want to give our presenter time to present his information. And then at the end of the presentation, we will have a Q&A session. We don't have the chat function on at this time. So we just ask you to write down your questions, and then at the end, we will ask you to present your questions. Also be mindful that you may have specific questions related to your circumstance. And if you do, then that's where we're available for appointments in the future, and you will see our contact information again so that you can contact us so that we can work with you. We know that this is not something, buying a home is not something you're going to do tomorrow. So we're okay with the establishing a relationship and working with you and moving you towards that. So with that, I will stop sharing and then I will turn it over to Roland. And much respect to you, Roland, as Roland shares his screen and starts his presentation with you.
All right, well, thanks for attending, guys. I know it's a Saturday morning. You guys are probably tired, but I think this is super important. You know, when I first met Gregory, you know, his house was in danger of falling out of escrow because the seller, I think they had a higher offer, right?
That's correct.
Yeah, they didn't want to let him go in there and do a secondary inspection for something that the lender was asking for. And in my lending, I've been doing this since 1991. So I've been doing this a long time. And what happened in my career is in 1999, 2000, I left and I started buying apartment buildings. So I had all these apartments and stuff, sold them all and decided to come back to the lending industry, but not just to do loans, but also to do like these specialty loans. I do renovation loans, energy efficient mortgages, construction to perm loans where people want to customize houses and build it from the ground up. Well, in Gregory's case, his realtor had heard one of my seminars on energy efficient mortgages. And what we are able to do is, without going back into the property, we're able to set aside some funds to fix the repairs that the appraisal called out. And we're able to close the transaction. And it just so happens that I knew the listing agent of Gregory's property because I'd owned some Victorian and some old homes near USC, and it was in the historical zone. And if you've ever bought anything, or if you own anything, or if you ever do own anything in a HPOZ, it's a historical preservation overlay zone. Yes. You'll have committees that say you can't do certain things to the property. Well, David, who's a listing agent on Gregory's property, when I told him what I was going to do, he started talking about, oh, you can't do that stuff. And I said, well, you can. And then he finally figured out who I was because he remembered me. And we were able to close the property. And, you know, that's how me and Greg met, you know, using the special little program that other lenders, 95% of the lenders do not even know what an energy efficient mortgage is. But we're able to close his transaction, which was awesome because he's got an amazing house. If you guys have been at his property, it's an amazing, amazing house. Mm-hmm. So, so that's how we met. You know, and we stayed in communications. And I told Gregory, you're a great resource for your community. Why don't you become a realtor? And he actually took me up on it. So here we are, you know, doing some seminars together. And he's a great guy, I'm sure, as you guys all know. And I think he's going to do some great stuff in that community. So let's get started with this first time buyer seminar. Let me share my screen. Let me go in here. Let's see here. Am I doing this?
And for all of you that are experts in Zoom, some of us are not experts in Zoom.
Exactly.
So we're learning all the little options that exist. All you educators that use Zoom all the time, the new method of education.
It really is. Okay, so I'm going to my share screen here.
Share screen, yes.
Okay, and there it goes. And share. Okay, you guys do not see that.
And it's coming up.
Is it coming up? Can you guys see that?
It says you have started sharing, and there you go.
Okay.
And we see everything on your desktop.
Okay, so I got the wrong one. All right. You can't see that? The Loan Depot?
I see renovation loans.
Renovation. Okay, that's the wrong screen. Okay. I got like 3 screens up, so I'm not sure which one it's reading. Is that better?
That's the first time buyer screen. Yes.
Okay, cool.
Right.
All right, so let's start the slideshow. Let me move my camera around a little bit. And from the beginning, let's go. Right. Okay. All right. Now you guys see that? It's all good?
It's
all right.
The first slide is we're good now.
Okay, perfect.
Seems
All
to
right,
be a little
guys.
delay.
Okay. All right. So the company I work for is Loan Depot. We're one of the largest lenders in the country. And we're everywhere. I mean, I refer deals all over the country. So it's a good, if you guys decide to buy something outside of the state of California, we can take care of you. On the screen, I put that Get Energy Smart because, you know, I think a lot of people are buying older homes, especially first-time buyers. And with these energy loans, you can actually make the house more energy efficient. You can redo windows, insulation in the walls. You can change out the water heater, buy actually appliances that are energy efficient, and finance all that into your mortgage. So I always put that in there because, again, very few lenders do that type of lending, and I do it. And I think it's a great way to buy your first home, because you're going to make yourself more comfortable, energy efficient, better indoor air quality. There's a ton of different things that you were able to do when you start using these programs. So, so with that said, let's get started with the first time buyer program. This is a little bit about me. I mean, I've been doing this for a long time. I've bought and sold and developed properties forever. I came back in the industry to really start doing these energy efficient mortgages and renovation loans, because it's a little niche that most people stay away from, but I think it's a huge benefit to the home buyers, especially first time home buyers, because they walk in, buy a house, and they pour all the money they have into the down payment and really don't have money to start fixing up the house. And again, I've had clients that I say, look, let me roll you into this program so you can have a gorgeous house within 6 months. And they say, no, I'm going to save up money and buy my, just do the things myself. 5 years later, when they go to refinance, the house is exactly the way it was. So why even go through that when you can actually have the funds to fix up and make the house gorgeous? So energy efficient mortgages, renovation loans, that's what lets you do that. And again, the cool thing about working with Gregory is, he's based on doing things for the community. I've had realtors where I speak and there's 100 different realtors, and I go contact them after the classes and say, are you guys going to use these programs? And they say, you know what, it's going to add another 5 days to the deal. I don't know if I can do that. And I think to myself, as a realtor, you have a fiduciary duty to really help your client. So why not tell them what's available so they can have a gorgeous, comfortable, energy efficient, just a home, instead of thinking about the commission that you want to get in 30 days. So Gregory lets me talk about this stuff because I think it's super important. And talking to the home buyer will allow them to know that these programs exist. And it's a battle sometimes in real estate, is trying to do the best for the borrower, because a lot of people just want to get the deal closed and move on to the next one. And it's I'm glad you guys are here to listen to this, because again, there's a lot more than just a loan, fixed rate or adjustable when buying a house. There's a lot of other programs that I say it's on the third page of the guidelines that really help borrowers really buy a house and finance a house that will be comfortable and just the house that they're proud of. A little more about Loan Depot. They like us to do this just to kind of get our name out there. Again, we're the super large lender. We'll kind of move on. All right. So home ownership, there's some clients that I talk to, and I talked to them for like 2 years about them wanting to buy a house, and well, maybe not now. In this market, people that bought 2 years ago, 3 years ago, are now selling their houses and have $150,000, $200,000 in equity and are moving up. So the people that didn't really want to buy, I think they missed an amazing opportunity. And anytime you can get out of renting and into owning, it's a good thing. And this slide here shows the benefits. It's owning. You're not going to have a rental increase, so you have a fixed housing costs. You got tax deductible interest, appreciation, and again, you put roots into your community. Renting, you got to deal with landlords. Something breaks, they don't fix it. it's just it's always continually going up. You're just giving away your money. Ownership, I like using acronyms, and I use the acronym ATM for a home ownership. It's the amortization of your loan. So every time you make a payment, you're actually investing in your future because you're dropping your balance on your mortgage. T is taxation, the tax deductible benefit, and you get to write off your interest. And M is the market increasing. So that's my little acronym for home ownership. It's ATM. And all that, when I take a payment, a $3,000 mortgage payment, and I start calculating in the amortization where you're dropping your balance, and then I put in the tax benefit, and then I put in the market accumulation, that $3,000 payment is as if you're making like a $1,200 rent payment, because all the rest of it is all benefits of a home ownership. And it's really tough sometimes when I'm qualifying renters, because they're used to paying like $1,500, and then their mortgage is going to be, $2,800. They're taken aback. But I got to explain that that's not a rent payment. That's actually a mortgage payment, and it's investing in your future. A lot of times when I do reverse mortgages for elderly people, I always have to meet, it seems like, with the family, because they want to understand how they work. And sometimes I tell them, look, for a person that had a regular job, that don't have a huge 401k, really their investing in a house is like their form of a 401k. So, my parents, for example, they bought a house a long time ago because there's 7 kids in the family, and no one wanted to rent to a family of 7 kids. So they're forced to buy a house. But that was the best thing they ever did, because now the house is paid off, and they have, it's probably worth $600,000-$700,000, and they can, if they needed the money, they can always do a reverse mortgage and pull money out, and that's like a form of a 401k. So if they would have continued renting, that would have never been possible. So tons of benefits over renting, and there's so many ways to be able to buy a house, and hopefully we'll go over some and it'll resonate with some of you guys. So this is an interesting slide. It's and this, I think, was from 2019. I couldn't find updated data, but this graph has just skyrocketed. The median price home in LA County is $709,000. Year to year increase in equity has been 10%, and they still, I think it might even hit double digits, or it's going to be in the high 9s or 8s this coming year, which is amazing. And I tell people, I qualify them. They're saying, you know what, I just want to save a little more. Man, you can't save enough to make up the difference in the equity gain if you don't buy now. And with what happened in 2007, 2008, people are afraid that the price is going to take a drop. And it's a different world. The economics of today's housing market is totally different than back in the early 2000s. Back then, all they cared about is your credit score, and they give you a NAGAM loan, which meant you had 4 payment options. You had the negative amortization, which meant every payment you made was less than what you should have actually made, and your mortgage balance was going up. And most lenders didn't explain that to borrowers, so they kept making that minimum payment, so that when they hit 125% of loan to value, the bank now said, you got to pay the full amortized payment. So their payment went from like $1,000 to $3,000. And that's when people just started saying, I can't do this. That's not today's market. Today, everybody is qualifying for their mortgages. You have to qualify for your mortgage. Rates are low, so the payments are kind of low. So now's the time to buy. 10 years from now, you're going to be happy that you bought, and that's just a fact. And it's just the way real estate works. I don't think real estate is something you look at 3 years out. I think 10 years out is the way to look at it. And a lot of people that were upside down but still like their neighborhood, still were making the payments. I mean, they're happy they didn't let the house go because it's probably doubled or tripled in price from back in 2008. So, so yeah, but the problem with affordability, how do you fix it? We'll go over some options that I think are great to use right now in today's environment. Okay, so how much? Well, this is I try to update the information, and it's very similar. It's just the high costs of owning in Los Angeles has made, even with low interest rates, it's crushing people's lives. So how do you take a renter and convert them to a buyer when they say, look, I don't even have money for the down payment? Because it's crazy. I got people making well over 100,000 and they say they can't afford to buy because they can't save for the down payment. But there are programs out there. There's a bunch of different down payment assistance programs that will help with that. But again, people that bought a few years ago, they're now buying houses 600, 700,000 because they're taking that 300,000 in equity and putting them down on these houses. That's why, people say, I can't believe how many people are putting these huge down payments. Well, it's because they bought 3 or 4 or 5 years ago. They took the leap and they trusted that what they were doing was going to help them in the long run. And it has, because now they're able to sell their house and move up into the neighborhoods with better school, bigger home, and take that huge down payment and get rid of mortgage insurance. So so that's kind of how a lot of this movement in I'd say the 500 to 700,000 range is happening, from people moving up from the house that they bought 3, 4, 5 years ago. So rates are starting to creep up. I think what's going to happen is, it's when rates creep up, listing times are probably going to extend a little bit. So there might be an adjustment in price, but it's not going to be anywhere near what it was back in 2008. So we'll see. It's just, I'm a crystal ball. We'll see what happens. All right. So now, in qualifying for a mortgage, let's talk about that. Again, I like acronyms. I say, buying a house is like, we investigate you. So I think CIA was an appropriate acronym for what we need when you buy a house. So it's always credit first, because if you have bad credit, I don't care if you make $1 million or have you're just not going to get credit. You got to pay cash for that house. Then it's income to find out how much house you can buy, and then assets to find out what kind of program I'm going to put you into. Do you have 3.5%? You'll go FHA. Do you have 20%? We'll go conventional. Or do you have nothing and we'll need to use a down payment assistance program? So that's for the asset side of things. So CIA, in that order, is how you qualify for a mortgage. Let's start with credit. So credit. Now, prior to COVID, FHA would allow you to do a loan for someone with a credit score of 520, which is amazing, but they'd have to put 10% down. I did a handful of deals that way, and it's funny because sometimes in lending you have to cross qualify with the listing agent's lender. So a few times they'd cross qualify, they look at the credit and said, you can't do this deal. I said, well, yeah, you can. He says, well, I can't approve this for my agent, who's a listing agent, because I can't do that deal. And I thought that was the most ridiculous thing I ever said. So I ever heard, right? So yeah, that program was available. I don't know if it's back, but it's very rare that I used it, but I did use it a few times. But right now, 580 using an FHA would be the minimum credit score. It requires 3.5% down. You'd have to have all your own funds, but 580 and still being able to buy a house, that's pretty darn good. VA requires 620 and a 640 score with a high balance. So once you go over a certain amount of mortgage, they consider it a high balance. So you need a little higher credit score. Conventional loans, 620 is the score you'd need. But sometimes when you have a 620 score, you're better off going FHA because the rate's a lot lower, because conventional is very sensitive to your credit score. So yeah, you gotta, what I always do is I do different scenarios and I see which payment is best for the client. But conventional will go as low as 620. Again, the rate will be quite a bit higher versus a conventional loan with someone that has a credit score of 720. It's very sensitive to the credit score. On jumbo loans, most lenders are 720, 740. There are a few out there that'll do a jumbo loan, which is over the 855,000, I believe, loan limit for the high balance conventional loans. And yeah, but there are some that do 680. They probably require like 12 months reserves. They have a lot of different guidelines. So yeah, so jumbo loans, I always tell people, look, they're going to require a lot of documents. So just get ready to supply a lot of documentation. So in order of ease, FHA is always the easiest. VA is very forgiving, and that's good because they're veterans and they deserve it. And then you got conventional loans. Then the toughest is probably a jumbo, just because they're investment companies and stuff. They just want to make sure their deals are tight. And I just yeah, it's a different world in jumbo lending. Here's a slide on what people always ask: what can I do to increase my credit score? You know, it's an algorithm, so they don't really tell us what makes up the credit score or what I can do specifically to help you increase your score. If it's a score that I think can be worked on, what I have is I have some software that tells me, you know, what to do, whether it's pay down a credit card or open up a small credit card, put a little balance on it so you have more credit. But if you look at the 5 factors, it's payment history, the amount owed, and length of credit history, new credit inquiries, and the type of credit. So if you have a lot of lates, there's not a lot you can do to increase your score quickly. Sometimes you can dispute the lates and they can correct them if, you know, because I've seen that happen quite often. Amounts owed, that's probably the easiest way. You pay down balances, because it's weird that if you have $1,000 credit card and you have $900 on it, that usage is way too high. It really will affect your credit score. They want you to use like 30-35% of the available credit, and that won't negatively affect your score. So the easiest thing is to pay down balances to increase your credit score, because that's 30% of the score. So if you look at the payment history and the amounts owed, that's 65% of your credit score. So those are the main things you got to focus on if you have bad credit, to try credit score, to try to raise your score. The other things are just 10-15%. So if you have low credit scores, paying down the amounts is probably the easiest. The hardest is trying to get late payments off. But sometimes if you have a good excuse and you got documentation, you can actually dispute the accounts and it be successful. So this is a good slide to let you know what causes your score to go down. And yeah, the higher the credit score, the better the rate you're going to get normally. So yeah, it's sometimes, you know, I got clients that come to me, they have super low scores. I do my little credit expert that tells them what to do, and 6 months later they come back and now their score is high enough where I can help them, you know, purchase a property. So income. So that's the credit version of section of CIA. Now the I is income. So income, it's anytime someone comes to be pre-qualified, I always ask what kind of income they get. Hourly is easy. you know, it's just 40 hours times the hourly rate, and you average the overtime. Salary is the easiest because you get paid, you know, 80,000 or whatever your salary is. It's divided by 12. Commission, I'll need full taxes. Self-employment, I'll need full taxes. And commission and self-employment are interesting. If you're on that type of salary or that kind of income, it's super important that you plan ahead for your home purchase, because you know, you go to your accountant. What's his job? To minimize your tax risk. So what he's going to do is write everything off. I mean, I have people that own businesses and they're very successful, but when you see their taxes, they report very little income, and they want to come and buy a house, and that's a problem. Now they do have stated income loans, like with bank statements and stuff, but those rates are in the 6.5%, 7%, and not threes. So you know, you're going to pay one way or another, either by a high interest rate or pay your taxes and get a low interest rate. So you just got to figure out what's important to you, you know. But commission, self-employed, it takes usually some planning on to make sure you're reporting the right income to buy the right house. Bonuses, we average 24 months, all your bonuses. Alimony, disability, child support. I think if there's still 3 years left, I can use that as income. So those are all the different types of incomes. I'm sure there's other things, but those are the basic ones that I deal with when I'm pre-qualifying clients. So yeah, if you're commissioned to self-employed, that's probably the toughest qualification, again, because you pay your tax preparer to minimize your taxes, so they're going to minimize your income to accomplish that. So I've had clients that go back and amend their taxes to increase their income, but I'm not suggesting you do that, but that's a way sometimes they get around having reported less income than they need. The last thing is assets. Okay, so you got your credit down, you got your income down. Now how are you going to pay for the down payment and closing costs? So obviously savings is the basic. You know, I need 2 months bank statements. Savings can't be in your cushion or at home in a safe cash, because we can't use it's got to be seasoned money. So it's got to be in your bank account for at least 2 months for me to use the asset. 401k, it's always a good one. You know, 401k, if you borrow money from your 401k, usually it's like they let you borrow 50-60% of your balance there. And when you pay it back, you're paying it back to yourself. So you're loaning yourself the money. That's a good way to come up with a down payment. You know, obviously earnings as you save them. Gifts, relatives can gift you the money, except for investment properties. So if you're moving into the property, you can get a gift from a relative and use those assets. Sale of an asset, when you sell your house, sell a car, you do got to document everything. Super important. You can't just come up with a lump sum of money and say, yeah, I sold a car. They want to see the bill of sale. They want to see all that stuff for us to use it. If you have none of that, that's where we kind of come into the first time buyer programs. And there's a bunch of different programs out there. The ones I use most are these three right here: the CalHFA, the SCHFA, and the GSFA. The one I use the most is the CalHFA. It gives you the most amount of money, and it's the easiest one to use. The difference between the three is that CalHFA is not a gift. It's a silent second, silent third. So I tell people it's kind of like having a rich uncle saying, look, buy a house, I'll lend you the money, just pay me 2% interest when you pay me off. And that's kind of how CalHFA works. So when you buy the house using CalHFA, you don't have to pay back the money until you sell or refinance the property. So it's silent. There's no payment has to be made. there's two parts to the CalHFA. There's the My Home and the ZIP. And the My Home gives you up to 3.5% for the down payment. Last year, they capped it at $10,000, which was really a bummer because before that, they basically covered the entire down payment. So now they say it in the guidelines, it's 3.5%, but now they capped it at $10,000. So so that's the maximum they'll give you. And then the ZIP program is zero interest, and they give you 3% towards your closing costs. So for a typical buyer buying something for 450,000, 500,000, the out of pocket is going to be about 8,000 to 9,000. That's using CalHFA. SCHFA and GSFA, those are grant programs. They actually give you the money. But the way those programs work, like GSFA will give you up to 4% of the loan amount towards down payment closing costs, but they charge you 2% to use the program. So in essence, they're giving you 2. But it is grant money. And if someone needs to use these down payment assistance programs, I look at all three and see which one's going to be the best fit for them. So those are the ways, those are the assets we can use for first-time buyers to buy a home. Oh, here's a little description of each program. And again, the loan limits are actually pretty high if you look at it. I mean, I was surprised they just updated them for this year. With the CalHFA in Orange County, you can earn $203,000 a year and still be considered a first-time buyer and they will help you buy the house. So that's a high threshold there. SCHFA is a little lower, and GSFA, the income limit is $156,780 for any location. They don't break it down by county. So so yeah, I mean, if you need some funds, this is always a place to look before you start asking relatives for money. So so yeah, it's a good way to buy a house. And again, CalHFA is probably the best, the easiest, and you do have to pay the money back, but they give you the most amount of money. So you know, the one thing with these programs is they do have minimum credit scores. So CalHFA and SCHFA, the minimum credit score is 660. GSFA goes as low as 640, but they give you probably the least amount of money. So, so yeah, these are the three programs that I tend to use. There's special programs like the city of Inglewood has one that gives you, I think they give you like $80,000, but it's so competitive. I think they roll it out in like March, and there's just a line of people ready to I've never been able in 30 years to get any of those funds for a client just because it's just so competitive. And I tell people, look, if you're going to be waiting there each year to hope to get that those funds, you're missing out on the equity growth in the house you could have already bought using CalHFA, which just makes more sense to buy it as quick as you can. Don't wait for the 80,000. So here's 5 tips to help accelerate your home buying timeline. You know, in today's market, there's literally, if it's a nice clean house, 30, 40 offers on that property. So sometimes, when you start fixating, I just want to be in that neighborhood, it prevents you from getting into the game and becoming a homeowner. Buy your first house where you can. I mean, and sell it a few years down the line, then buy in that neighborhood. There's steps to getting in the neighborhood that you want to be. So the key is to get out of renting and start owning, so you can start building that equity to be able to buy your next step up home. So don't fixate on the neighborhood. Explore low down payment financing and local assistance programs. We talked about that previously. That's the CalHFA, SCHFA, the down payment assistance programs. Downsize your lifestyle. Everyone wants a 4-bedroom, 2-bath house, to have space, but sometimes getting in the game is the more important thing. I had a client, she must have been looking for 3 years. Finally, she found a house. It was a 1-bedroom, 1-bath, but it was in the neighborhood she wanted. And she just pulled the trigger, bought it. And I think last year she sold it and moved up to a 3-bedroom, 2-bath. But she was able to gain, like, I think it was at 80,000 in equity by just buying that 1-bedroom, 1-bath. And she was able to put a big down payment for her next purchase. So sometimes in real estate, you got to think about the steps that it takes to get to the neighborhood that you want to be in. Fourth thing is consider a renovation loan. I do a lot of those renovation loans. I'll have some pictures. I think it's later in this presentation on some of the properties I've done renovation loans for. I mean, it's in today's market, a renovation loan should be used a lot more than they actually are. Some of the properties I financed with renovation loans were insurance, like, I don't know, buyouts, I guess, where the house is half burnt down because there was a fire. We go in there, we gut them, we put new roofs, just change everything out. Most people are running away from those houses, but I tell my clients, look for those houses. If an investor is looking at the same house as you're looking at, odds are, if it's a listing agent that understands, they'll take your offer over the investor, because the investor is trying to lowball the deal to make money, where you as a homeowner want to live in it. And I just opened up escrow last week on a property that's exactly what was happening. There was a kitchen fire. It was all burnt out in the kitchen. Investors were lowballing the sale price. And my guy went in there, made an offer, added the repair cost for it. And we opened escrow. So he beat out an investor using a renovation loan. So it's a great way to buy property in today's market, because a lot of people want turnkey. And I'm not saying that renovation loans are easy, because there's, you got to go in there, work with a contractor, but I think it's pretty rewarding when you end up with a house that you want, that you like, the way you like it. And it's a good choice in today's market. Maximize your credit score. That's going to get you the best interest rate, and it's going to open up more programs for you. So even if you just have a little thought about buying a house, run your credit score. I mean, if you go to my website, you can actually input everything, and you can push the button and it'll give you the scores. It'll actually run your credit and give you scores, and doesn't cost anything. So that's the 5 tips to help accelerate home buying timeline. And they're all good ones, and I think everyone should look at these and really take some time to figure out what exactly they want and what property, what area they'll be buying. Because I know in LA, prices are just ridiculous. And but low rates are allowing those payments to be made affordably, quote unquote. So when someone comes to me and Gregory, I think I'd sent you the home buyer assessment forms. We're able to, I don't know if you're able to shoot them out, and so people can kind of take a look at the information that we look for when pre-qualifying a client.
Yeah, I was able to send it out to those individuals that had pre-registered.
Okay. Yeah, because on this form, once someone fills this out, I can really go in there and just pre-qual the people. It asks all the information that I need to figure out where you're qualifying, what sales price, what programs I can get you into. It's a simple form. It's worth the 10 minutes it takes to fill out. And it touches on all 3 bases of the CIA: credit, income, and assets. And again, those are the 3 things I need in order to properly qualify you. And this is my old little 10 commandments of buying a home. I have a little plaque and I have it on my desk. So, and I tell people these 10 commandments are pretty interesting. I've been in the business forever, 30 years almost. And every single one of these has happened. Don't change your job. Or if you're thinking about changing your job, call me, because sometimes if it's a lateral or up move, it's okay. It's when you change careers that are totally opposite of each other that it's going to affect you. Don't go buy a new car. We're already tight on the ratios, but I've had people do that. Well, my lease was up, I need to get a car. Well, don't have a car for a little bit. Go buy a $500 car. I don't know. But now you got an $800 payment you didn't have before. Don't use credit cards to buy stuff for the house that you have that's not yours yet. I have people buying furniture and refrigerators. It's like, it's not even your house yet. So yeah, don't do that. Don't spend your down payment money. Don't omit debts or liabilities from your loan application, because they do some background checks, man. It's crazy. I don't know where they pull this stuff up, but they say, hey, there's a property in Arkansas that you own. Well, I didn't know that was going to pop up. Yeah, it does. They'll find it. Don't buy furniture for a house that's not yours. Don't go out and start your credit ran, because we'll ask, did you open a new credit? Because the underwriter will run a backup report before we close, and it'll show that if you had any inquiries. And number 8, don't make large deposits, because if it's unsourceable income, I can't use it. Don't change bank accounts. Oh my gosh. I've had people that have like 5 accounts because they keep putting money on the Christmas fund and this and that. And then they try to consolidate right in the middle of transaction. And that's like playing whack-a-mole, trying to find out where the money is. It's not fun, and that's not what you're supposed to do. So don't do that. And the last one, I got clients that, they make pretty good money, but they tend to co-sign for people. Oh my God. I had a guy that had 6 car payments. So you have 6 cars? Like, no, I co-sign for my cousin, my aunt, my brother. It's like, oh, dude, well, you get to live in your car because you can't buy a house anymore. You got $3,000 in car payments. So try not to do that. And those are the 10 commandments of buying a home. And the last thing I think I'm going to talk about for this session is supplemental property taxes. And it's kind of odd that I talk about this, but as first-time buyers, you don't know what this is. So anytime you buy a house, if you bought a house from an original owner that paid $40,000 for the house, when you go close your real estate transaction, they close kind of the tax assessor uses that tax base to calculate your taxes. So when they go out there and actually calculate that you paid $500,000 for the house, you're going to pay a supplemental tax between that 40 and that $500,000. So it's a big tax bill. That's a supplemental tax bill to the regular taxes you get. And it's sometimes it's a surprise to people. And a lot of realtors don't mention this. And it's important that they understand that first year of ownership, more than likely they'll get a supplemental tax bill. And they always call me and say, hey, Roland, I thought that my taxes were in my payment. I said, your regular taxes are, but your supplemental tax bill isn't. So I like to bring this up, and it's just important. And I know first-time buyers don't have any clue usually about supplemental tax bills. So I'll end my first-time buyer seminar with that. I think we're running a little late here. I think we're on time though, right?
We're good.
Yeah,
we're good
okay,
on time.
we're good.
We're good on time.
Yeah.
Okay. So Roland, if you would stop sharing your screen.
Okay.
And then neighbors, community members, we will open the floor up for any questions that anyone will have. Just be mindful that if it's a very specific question to your case, then that can be dealt with by an appointment. We can set an appointment with you to work with you, and we're showing all of our information so that you can either contact me or contact Roland. You might want to take a picture of this screen so that you can have our wonderful mugs on your phone, but mostly our contact information to call us or email us if you have a question. Again, our major thought as we present this information that you heard Roland say, he worked with individuals for months, and we know that it is a process. You may have one question now, and then when you have that information, you start working on that. And then as time moves on, you may have another question. So it is a learning process. So please do not think that we're looking at you for you to say that you want to buy a house tomorrow. Now, if you do, great. We're all, we're not going to say no to that. But just be mindful that we realize that as we're supporting our community, it is a journey. And as we ask questions and as we make progress, you may have one question today, you may have another question next week, and we're willing to build that relationship with you. So again, our information is there with you. We want to thank you for attending our first time homebuyers workshop, and special thanks to Roland Macias that has shared a wealth of information with everyone that attended today. We feel that this is a commitment to our community, to you as a home buyer. We want to work with you. We understand, as we shared before, that this takes time, but as you can see, our contact information is provided so that we could talk with you and answer your questions and get you started with the process. Now, there's a step that is required of you. You have to reach out to us and let us know that you really want to move forward with this process. Let Roland, the expert, work with you on securing that loan to see your home buying power. So with that, have a great day.